Many investors are excited about stock splits. Amazon has announced a 4.15% split, and Alphabet has announced a 2.53% split. Other companies have also announced similar stock splits lately. There is no change to the fundamental value of any company that receives a split, but many investors are simply excited about them because of its unique qualities. The splitting of a company's stock may not seem like a big deal, but the opportunity evaporates quickly. Even though these companies are good buys, many are watching Amazon, Shopify, and Restoration Hardware. Here's why. Luckily for you, Fortune Fastlane, we've listed the best stock splits you should keep an eye on. Let's dive headfirst into what stock splits are. Stock splits occur when a company divides up its shares to lower the price and increase the overall number of shares available. Stock splits happen often when a company's share price becomes too high. While stock splits are cosmetic events that are not fundamental to the business and do not actually change the corporation, there is ample anecdotal evidence suggesting that they yield wealth. One example is Nvidia. Nvidia announced a stock splitting 4-for-1 in May of 2021, and the share price rallied after the news was released. The split occurred July 19, where shares increased by 20%. Today, we are discussing 6 companies that announced or already underwent stock splits in 2022. Not every company featured is a recommendation, but this list of companies undergoing a stock split may be helpful to investors who are interested in learning more. Number 1. ACM Research. Market value, $716.4 million. Stock split, 3-for-1. The stock of ACM Research, which develops and manufactures semiconductor processing equipment for wafer-level production applications, begins our list of stock split stocks. This company primarily sells single wafer cleaning equipment and considers its products to be the most efficient in its class, offering higher yields and greater efficiency than other competitors. ACMR has been granted more than 350 patents to protect their technology. By doubling product development in 2021 and adding 2 new product categories, ACM Research is reaching a broader market opportunity. ACM Research saw its revenues increase 66% and EPS grow 73% in 2021. In April, the company warned that March quarter results were likely to fall short of guidance due to the COVID-related restrictions in Shanghai, which has greatly impacted employee access, production, and logistics, and ACMR's ability to ship their finished products to customers. On a year-over-year basis, revenues fell 4%, and the firm posted an adjusted per-share loss of 1 cent versus earnings of 12 cents per share 1 year ago. Another risk is ACM Research's financial reliance on China, which purchases most of its semiconductor manufacturing equipment. Greater trade conflict with China could negatively impact ACM's financial results, though ACM does hope to mitigate risk by finding new customers for their products outside of the country. ACMR launched a 3-for-1 stock dividend in March, which was paid out on March 23. We are implementing this stock split to make stock ownership more affordable for investors and employees, said Dr. David Want, CEO of ACMR Research, when the stock split decision was announced. Shares for the semiconductor company ACMR have fallen by roughly 59% into 2022. Many investors are feeling cautious about the investment due to elevated risk and reduced guidance by the company. Despite these risks, most analysts still recommend that their clients purchase shares and call ACMR a buy. Number 2. Alphabet. Market value, $1.50 trillion. Stock split, 20-for-1. Alphabet is the parent company to Google, and its offerings include Chrome, Android, Google Search, Google Maps, Gmail, YouTube, and a slew of other apps. Alphabet's 3 business segments are Google Services, Google Cloud, and Other Bets. These are a combination of pre-revenue generating businesses that are not yet material in revenue contribution on their own, but are still important for future success. One of the few mega-cap stocks on Wall Street, Alphabet has generated steady double-digit revenue and EPS growth over the past decade. Google shares have returned approximately 150% over the last 5 years, far exceeding 80% of the S&P 500 total return for the same period. Alphabet Incorporated reported 23% sales growth year-over-year in the March quarter, which is their slowest growth rate since 2020. Alphabet blamed the slowdown on inflation, supply chain disruptions, and the Ukraine war, which are reducing spending by advertisers, especially in Europe. Alphabet's net income dropped 8% compared to analysts' projection, largely influenced by tough year-over-year comparisons, and the company's decision to suspend operations in Russia. Google's cloud services, although losing money, remains a growth area for Alphabet, since it has increased 44% in the March quarter. Plus, Google also plans to invest $5.4 billion in Mandiant to expand its cybersecurity capabilities. Deutsche Bank analyst Benjamin Black has reiterated his buy rating on the stock of Google in March quarter. He noted positive elements for the quarter, including strong margins and that the performance of Google Search continued to remain strong, while engagement with YouTube Shorts have experienced rapid growth since its launch in December 2017. YouTube Shorts is a new service that has been competing with TikTok. In February, Alphabet announced a 20-for-1 stock split and will release this on July 15. The Google stock split requires shareholder approval and will be put to a vote on June 1. Alphabet recently announced the creation of a new share repurchase program and could buy back up to $70 billion more of its own shares. Opportunity exists for Google's Google stock price traders anticipating a split. Based on recent close, Alphabet stock would trade at around $113 per share, much more accessible than the current high of $2,272 per share that is currently priced at. Number 3. Amazon. Market value, $1.7 trillion. Stock split, 20-for-1. Amazon has seen capital gains for over 2 decades, and the company reinvesting into their core business had paid off because of their consistent double-digit sales and EPS. Amazon is best known for its e-commerce platform, but derives increasing profit from their web services and digital ad segments as well. Amazon.com announced a 20-for-1 stock split set to take effect on May 25. Amazon will be lowering the price of their stock from $3,100 to $155 in order to approach an IPO valuation. The impact on my investment thesis for Amazon will not change at all, except for the fact that the board of directors expect more share price growth. A stock split is purely a mathematical exercise, much like cutting a pizza into a large number of smaller slices. It still adds up to the same delicious tomato pie. Business is booming. Amazon's revenue was over $470 billion in 2021, just a hair short of $500 billion. If Amazon was a country, its GDP would be on par with Sweden's or Thailand's. The company's sales grew 27.6% last year, faster than any nation's gross national product growth in the same period. As labor shortages, supply chain issues, and increasing costs have pressured profitability and slow growth, Amazon has invested in its chains, cloud, and other areas like logistics. Amazon posted 7% sales growth for the first quarter of 2022 and saw operating income fall nearly 60% from 1 year ago. During the second quarter of this year, Amazon is making projection for 3% to 7% sales gain, but also could be carrying an operating loss. Despite Amazon's historic growth and fast-rising stock price, its share prices were underperforming that of the S&P 500. At the same time, Amazon announced a 20-for-1 stock split to attract new retail investors as it has not done since 1999. The split was also part of a larger $10 billion share buyback plan. One of the analysts who follow Amazon recently called it one of the best-positioned companies. They have a buy rating on Amazon stock and expect improved efficiencies due to the new fulfillment centers and profits from their web service, as well as digitized ads. Number 4. Shopify. Market value $40.2 billion. Stock split 10-for-1. It did well during the pandemic, but shares have plummeted in 2022 for companies like e-commerce sites due to concerns about slower growth. Shopify is a leading player in e-commerce, providing software, marketing teams, and services to help other businesses grow. Even though it doesn't sell anything directly to consumers, the companies build brands with its portfolio of apps and websites. This e-commerce technology company has been a great investment since their IPO back in 2015. The company has not had any noticeable downturns in the market, with a 2,160% run over the last 7 years, which includes a recent 60% decline from all-time highs. As of late, Shopify has been in the headlines because of their announced 10-for-1 stock split. The action is meant to modernize Shopify's governance and structure. Among other items relating to the stock split, co-founder and CEO Toby Lütke will be granted a founder share, which will concentrate 40% voting power and will have Toby Lütke as the sole decision-maker over the future development of Shopify shares. Shopify's market share may soon be in jeopardy, given Amazon's new Buy with Prime feature, which is seen as a direct competitor because it allows third-party websites to tap into its fulfillment and delivery network. At present, Shopify has 10.3% share of the U.S. retail commerce market, faring second only to Amazon's 41%. In an attempt to expand its fulfillment services and compete more effectively against Amazon, Shopify in late May said it is purchasing Deliverr, a San Francisco-based startup that specializes in technologies for building fulfillment networks. The cash and stock deal is valued at $2.1 billion. Shopify is also partnering with digital payment platform Stripe to accept Bitcoin payments on its network. Ahead of Shopify's Q1 earnings, Stifel analyst Scott Devitt expects inflationary headwinds to affect Shopify merchants more noticeably from Amazon.com's product mix due to these differences. This is because the consensus estimate for Shopify is not including true market headwinds, according to Citi analysts. Number 5. NAPCO Security Technologies. Market value $580.4 million. Stock split 2-for-1. NAPCO Security Technologies, also known as NAPCO, designs and creates electronic security devices for commercial and residential properties. The company sells its products in the United States via a network of 200-plus distributors, 10,000-plus independent dealers, and 2,000-plus independent integrators, who then install alarm systems in airports, office buildings, schools, and hospitals. In May, the company announced fiscal third-quarter results, which revealed a 27% year-over-year rise in sales. Gross and recurrent revenues rose 35% during the 3-month period to contribute 33% of total revenues. While the increase in demand for school security has been exerting more pressure on its bottom line, NAPCO is capitalizing on the spike in popularity of its supply of COVID-related lockdown devices. Based on a survey from 136,300 schools, it estimates that a $10 billion market opportunity exists. In the upcoming year, NAPCO sees a market opportunity for $4.9 billion with dormant landlines and alarm systems, which will be replaced first. Along with that, the company also sees approximately $49.9 million annually in recurring revenue by the end of April 2022. Before the rest of the market was awestruck by a 2-for-1 stock split, NSSC preemptively announced the adjustment last year. The stock split took place on January 4. 4 out of 5 analysts say that NSSC is worth investing in. Investors are encouraged by the company's rising recurring revenues and upcoming upgrade cycle in the school market. Number 6. RH. Market value $6.9 billion. Stock split 3-for-1. Billy Duberstein of Restoration Hardware said, "There is a lot of fear over a possible recession next year, but no one knows for sure. The current environment is reminding me of late 2018 when the Fed raised rates as the US-China trade war was intensifying, which triggered market instability," says Duberstein. Turns out, that period was a great buying opportunity for retailers. Right now, the market fears that the high oil prices and the increased cost of food will cause consumers to cut back on discretionary spending. The best example of this is home building giant RH, which has lost over half its value in just half a year. It now trades at a price below its estimated earnings multiple of 13.5 times for 2017. RH is so appealing because it's changed its target audience from people who want a cheap product to one of those affluent consumers who can afford luxury versions of the same items. The strategy has been working, with revenue and margins rising year over year in line with the increasing recognition of RH as an affordable luxury brand. RH's CEO Gary Friedman says the trend is continuing into the future and believes that RH could generate the 30% operating margin seen by those most prominent luxury brands in the world, those that can sustain good economic times and bad. 2022 will be a difficult year for the housing market, with inflation, consumer demand waning, and high input prices. In March, management only guided for 5% to 7% growth in 2022, down from 32% last year. The demand slowdown happened along with Russia's invasion of Ukraine. Warren Buffett's Berkshire Hathaway has owned RH stock since 2019, and one of Warren Buffett's favorite investing styles is to buy a company when it gets temporary trouble. Although the economy may slow, RH is steadily rising, as hotels, restaurants, chartered planes, yachts, and even luxury homes are now on RH's horizon. They will be able to expand their brand in all directions. RH Home Furnishings are members of the Berkshire Hathaway equity portfolio and sell high-end furniture, textiles, and decors at 67 retail galleries and 38 outlet stores across 30 US states and Canada. Gordon Haskett's analyst Chuck Grom expects the company to use the $2 billion of cash on its balance sheet to buy more shares or debt, noting that the price of RH shares have fallen precipitously in the past year and a half. With the cautionary stance taken by RH management, Wells Fargo analyst Zachary Fadem remains optimistic about the company's future. He thinks that the company's sales guidance will end up being conservative and their estimate for their fiscal year 2022 earnings were accurate, and thinks the stock is priced more attractively for investors with a long-term perspective. That's it for this video, Fortune Fastlane. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!